The biggest issue faced for most traders is that they can correctly identify the right liquidity levels, but when it comes to trading them, they aren't sure how to actually confirm if the reversal move is valid, or if the level just got wicked through before continuing in the same direction. But this is where we can use a CISD confirmation, which is a simple yet powerful ICT concept that can provide the trader with clear criteria that confirms whether a liquidity run or a liquidity sweep is playing out in real time, giving a huge amount of confidence to every trade you'll make in the future. So in this video, you will learn what CISDs are, how they can be used to detect and trade market reversals, as well as how they can be used to confirm whether higher timeframe PD arrays have been respected or disrespected. So let's waste no time and start with step number 1, which covers what CISDs are and the criteria we use to confirm them. CISD is the abbreviation of a concept called change in state of delivery, which is used to signal when the market's price action has impulsively switched in direction, from either bullish to bearish or bearish to bullish. And they're most commonly used as a confirmation signal for when the market has switched direction after attacking a key level. So let's show how this works. Here we have a small section of a chart that contains a downtrending structure, and just below this, we have a higher timeframe liquidity level. And as we know, when the market attacks a key level, there's a good chance that a reversal move could occur, even if only for the short term. So when we move forward in time, we can see that this level ends up getting hit. And if we suspect that the market might now create a bullish rejection, we might look to enter a long trade. But this is where most traders go wrong, because they either enter at the first touch of the liquidity level, or when the market has pushed back over the level. But a lot of the time, the market then moves back the other way, hitting the stop loss of the trade. And the reason why this kind of entry is bad is because we haven't yet had a confirmation that validates the idea that a reversal could be occurring. So, to solve this issue, we can wait for a CISD to form and use it as a confirmation signal for the reversal. So in this chart scenario, in terms of looking for a bullish CISD, we want to look at the most recent bearish leg that attacked the liquidity level, and then mark out a level from the open of the first bearish candle. Because if the market were to push up and close above this level, this would create the bullish CISD that we're waiting for. And the idea behind this concept is that when the market next retraces back to this level, we can expect it to act as an area of support in order for the next bullish leg to be created. And as a result, the latest swing low of the bullish leg will be protected, which means that as long as the next swing low forms within the area between the CISD level and the swing low, the bullish CISD is being respected. But just so we are clear on the level that we use for our CISD confirmation, it is drawn from the open of the first candle in the bearish leg that created the latest swing low in the downtrend, which means that if the market hadn't created this bullish CISD and instead pushed lower, breaking through this latest swing low, the new bullish CISD level would be drawn from the open of the first bearish candle of this new bearish leg instead. And the same goes for bearish CISDs too, it's just the other way round, meaning that we use the open of the first bullish candle of the bullish leg that broke through the latest swing high in an uptrend, and we would expect this to act as an area of resistance where the next lower high can form, reversing the order flow from bullish to bearish. But before we continue, there's two important pieces of criteria to be aware of when it comes to CISDs. The first is that in order to validate the CISD, we must see a candle close past the level. For example, if the market were to push through this level before then retracing back down, this wouldn't validate the CISD. It's only with the candle closing above the level that the confirmation criteria is met. And then for the second piece of criteria, it's important to understand that a CISD can be created from either just one singular candle or multiple consecutive candles. For example, in the case of this bullish CISD, we can see that the bearish leg that created the CISD consisted of two bearish candles. But in this other example, we can see that there was only one bearish candle that created the bullish CISD. So it doesn't matter how many candles are within the leg that forms the CISD. What is important is that they are all the same color, meaning in the case of a bullish CISD, we would only use the bearish consecutive candles, with no bullish candles found in between them, with the CISD level being drawn from the open of the first bearish candle. And this is the same for bearish CISDs too, in that they can consist of either just one bullish candle or multiple consecutive bullish candles, with the important criteria being that there is no bearish candles mixed in between. And again, we would draw out the bearish CISD level from the open of the first bullish candle of the sequence, whether it consists of only one bullish candle or many. So this explains the criteria we use to define a CISD, but this only covers the very basics. So we need to move on and take a look at some of the more advanced methods that they can be of use to a trader. But before we look further into this, I wanted to quickly mention that we have just released our Smart Money Concepts TradingView Indicator package, which includes 3 customizable multi-time frame indicators that implements over a dozen different concepts, including the CISD concepts that you'll learn in this video, as well as all of the other concepts we have covered so far on the channel. And for a short time only, we are offering offering a 7-day trial period where you can test the indicators out for completely free, which can be found through the link in the description. So check it out at the end of the video once you understand all there is to know about CISDs. So with that out the way, let's move on to the next step, which covers how lower timeframe CISDs can be used to confirm higher timeframe PD arrays. Here we have a chart on the daily time frame, where the market has just attacked a liquidity level, which was this previous daily swing high. And just by looking at the long top wick of the most recent daily candle, we have a very clear example of a bearish CRT pattern. So we can make the assumption that the market has successfully rejected from this liquidity level, with a high possibility of it pushing lower in the following day, which means that this might be a good opportunity for us to enter a short trade. But at the same time, we haven't actually seen any confirmation signals to tell us whether this liquidity sweep is actually valid, and guessing is never a good strategy when it comes to trading. So before we can enter any short trades, we need to confirm that the market has actually rejected from this daily timeframe level by seeing whether it has created a bearish CISD within the lower timeframe market structure. So let's now zoom into this latest daily candle to get a better understanding of what happened on the 1-hour time frame. And straight away, this lower time frame gives us a much clearer idea of how the market reacted to this level, with the move that attacked the daily level having a very strong impulsive rejection. But whilst this might look promising, there is one issue with this market structure in terms of looking for confirmation for our bearish daily bias, which is that if we look at the bullish move that pushed up and attacked the daily liquidity level, the opening level of this bullish leg has yet to be closed below, which means that whilst this bearish retracement move down clearly has a lot of strength, we haven't yet seen the creation of a bearish 1-hour CISD. And in the case of confirming the reversal move from the daily level, we need to see this CISD confirmation to support our bearish bias. But in addition to this, the latest bearish leg down is also sitting within the area of the most recent bullish order block, which was created just before the initial attack of the daily level. And this conflicts with our bearish bias, because this bullish order block could potentially be used as an area of support to push the price back higher. So what this means is that in order for us to continue with our trade idea, we also want to see the low of the bullish order block also get disrespected, with a candle closing under the area in order to have any confidence in the bearish reversal being valid. Which means that, as it stands, the most suitable thing to do would be to just step away from the market to see what actually happens. But by having a little patience, we can see that the next candle managed to close below the bullish order block's area whilst also confirming the bearish CISD in the process, which means we can now finally start thinking about where we can enter our short. But what would make a good entry position in this scenario? Well, we of course have the bearish CISD that if the market was to test, we would hope to act as resistance, shielding the latest swing high from being hit. But if we also look to see if there are any other bearish PD arrays within this market structure, there is this 1-hour bearish fair value gap sitting just above the CISD level. So this could be the most ideal area to use for a short entry target, with the benefit of having the confluence of two bearish 1-hour PD arrays backing our trade idea. So now, moving a little further in time, we can see that the market ends up pushing back up into the CISD before reaching the area of the fair value gap, which means the market is now at the price area that we were targeting. So we would be justified if we wanted to now enter our short. But at the same time, whilst we can clearly see that the fair value gap is being tested, we again don't actually know if the fair value gap is being respected or not, because what we can see on this 1-hour time frame just doesn't give us enough information. So what can we do? Well, we can just use the same logic as we did before by again moving down into a lower time frame, like the 5-minute chart, to see if there is a bearish 5-minute CISD that we can use as a confirmation signal for whether the market is respecting the 1-hour bearish fair value gap. And by looking at the opening level of the latest bullish leg that tested the 1-hour fair value gap, we have the CISD confirmation we are looking for. So, if we wanted to enter a short, we now have all of the confirming criteria to validate the trade idea, and even have a bearish PD array that we can target for our entry, being the bearish CISD. And the benefit to this is that through using top-down analysis, we have aligned each time frame with the bearish bias of the daily reversal setup, and then used bearish CISDs as a way of confirming our bias, as well as to confirm whether the bearish FVG we used as our entry area was being respected. And if you think these concepts would work well within your trading strategy, we have developed a series of powerful ICT TradingView indicators that implement the logic of everything you've learned in this video, along with all of the other concepts we have already covered on our channel. And for a short time only, we are offering a 7-day trial period where you can test the indicators out for completely free, which can be found through the link in the description. And if you found this video helpful, please leave a like and a hype, and comment which ICT concept you'd like to see us cover next.